Welcome back to the Morning Brief, brought to you by Invesco. Investor sentiment shifting amid concerns over the Fed's path to rate cuts, according to Bank of America's Global Fund Manager Survey. We've got Yahoo Finance's Josh Schafer here with the details. Hey, Josh.
Hey, Brad. Yeah, so always a lot of charts to break down in this Fund Manager Survey. Bank of America surveys over 500 fund managers. And the survey, interestingly, I think this is important to point out, was done from August 2nd to August 8th. So that means it started the day of that weak July jobs report and went throughout all of last week's volatile market trading. And one of the key takeaways for me was that you're still seeing investors confident in a soft landing. So the soft landing odds, the amount of respondents saying they see a soft landing hit 76%. That's the highest we've seen since the data set that Bank of America provides here, dating back to May 2023. The key other movement here would be that hard landing risk also went up. So what went away was the no landing. Remember, no landing would probably come with strong economic growth. So you're seeing a little bit of a bet there that essentially the overachieving U.S. economy is no longer where people are placing their bets at this point. And the key part to this that Michael Hartnett, who runs this survey, pointed out within it, is that this is driven by expectations for lower interest rates. So there's another chart that Bank of America provided here of how many cuts people are expecting. Interesting to look here. So purple is August. There was no bets on 4 cuts in the light blue or the pink line until a week ago. Now everyone, 60%, are saying 4 cuts or more. So yes, people are saying they feel like we can achieve a soft landing, but that comes with the expectations of quite a few Fed rate cuts. So it gives you the mind of how investors are thinking about this, that the soft landing is still achievable, but it's going to take some help from the Fed at this point.
But that kind of contradicts itself, right? If you're going to be forced to cut 4 times, maybe even more than 4 times was that second line, I believe, you would be doing that because you think the economy is there's something very wrong, right? So I guess, and I bring that up because then it's almost like how much of this, and this really goes back to the conversation we were having last week when you take into account the market's reaction to everything that played out following the jobs report, everything that played out overseas or sparked by what happened with the Bank of Japan, is whether or not that's an overreaction and something that's going to be recalibrated very quickly too.
Yeah, I mean, well, you look at, they have data on sort of where people put their money too, right? And you saw the largest move out of stocks since September 2022 on a month-over-month basis, and you now see the lowest allocation to stocks since January 2024. The market got defensive. Investors got defensive for sure. But one thing, Sean, I was looking into this. I was thinking about what some of the economists have been telling us. So Seth Carpenter over at Morgan Stanley, the chief global economist there, he's calling for 3 rate cuts. So 1 less than 4. But he said he thinks if we get 3 rate cuts based on the current data and the data doesn't get worse, that's soft landing. Right. So we're not that far off. And he said the market's pricing a little bit more right now. And to him, that makes sense because the risks sort of to investors feel like they came out of nowhere. Yeah. But maybe it's just a fine line, right? Like the path has gotten significantly narrower, but the path is still there for now.
Yeah, and it's also consistent, right? Kind of just what we've been seeing the market price out in terms of rate cuts versus maybe what is the more realistic view. Even when it comes to what we've seen from the dot plot, even what we heard time and time again, the messaging from the Fed, and then versus what the market wants to hear and wants to believe.
Yeah, and then I wonder if we don't get the 50 that the market's pricing in, how are people going to feel? Yeah. Do we need 50 bids in September for you to get your soft landing? I don't know, but that's what the market seems to want right now, and is that going to move over the next month?
And then even that conversation, we got to go here. But even that conversation, I feel like, has kind of shifted over the last 1 or 2 trading days, just in terms of the need for 50 versus the want of 50, and more realistic.
To me, it's more of a want right now than a need, is what it seems like.
Yes, definitely.